Your credit score is one of the most important numbers in your financial life in the United States, and most people have no idea how it actually works. They know it exists, they know a higher number is better, and that's about it. But before we get into how it works, I want you to stay until the end of this video, because the last thing I'm going to tell you about credit scores is something that could cost you or save you hundreds of thousands of dollars over your lifetime. And almost nobody talks about it. A credit score in the US is a 3-digit number that ranges from 300 to 850. It's calculated by credit bureaus, the main three being Equifax, Experian, and TransUnion. And it represents how trustworthy you are as a borrower based on your financial history. The higher the number, the more lenders trust you, and the better the terms they're willing to offer you. What most people don't realize, these three bureaus operate independently, meaning your score can actually be slightly different across all three of them, depending on which lenders report to which bureau. That's why when you check your credit, it's worth looking at all three, not just one. The score ranges break down like this. Anything below 580 is considered poor, and at that level, you're going to struggle to get approved for most things. And when you do, the interest rates will be painful. From 580 to 669 is fair. You'll get approved for more, but you're still not getting the best deals. From 670 to 739 is good, which is where most Americans sit. From 740 to 799 is very good, and anything above 800 is exceptional. At that point, lenders are essentially competing for your business. Now, how is the score actually calculated? There are 5 factors, and they don't all carry the same weight. The biggest one is payment history, which makes up 35% of your score. This is simply whether you pay your bills on time. Every on-time payment works in your favor, and every missed or late payment works against you. One missed payment can drop your score by 50 to 100 points overnight. That's not a small thing. And it doesn't matter if you missed it by 1 day or 30. Once it's reported as late, the damage is done, and that mark stays on your report for 7 years. The second factor is a credit utilization, which makes up 30% of your score. This is the percentage of your available credit that you're currently using. If you have a credit card with a $10,000 limit and you're carrying a $3,000 balance, your utilization is 30%. Most experts recommend keeping this below 30% and ideally closer to 10% if you want a high score. Here's a trick that a lot of people miss. If you want to lower your utilization quickly without paying down debt, you can request a credit limit increase on your existing cards. If your limit goes up but your balance stays the same, your utilization percentage drops automatically. It doesn't work forever, but it's a legitimate way to give your score a short-term boost. The third factor is length of credit history, which accounts for 15% of your score. The longer you've had credit accounts open, the better. This is why closing old credit cards isn't always a smart idea. Even if you don't use them, keeping them open helps maintain your average account age. If you close a card you've had for 10 years, your average account age drops, and your score can take a hit even though you technically did nothing wrong. The fourth factor is credit mix, which makes up 10% of your score. Lenders like to see that you can handle different types of credit: a credit card, a car loan, a student loan, a mortgage. Having a variety of account types shows you're not a one-trick borrower. You don't need to go out and take on debt just to improve this factor, but it's worth knowing that a diverse credit profile does work in your favor over time. The fifth factor is new credit inquiries, which also accounts for 10%. Every time you apply for new credit, the lender does what's called a hard inquiry on your report, and that temporarily lowers your score by a few points. Applying for 5 credit cards in a month sends a signal that you might be in financial trouble, so try to space out your applications. One exception worth knowing: if you're shopping for a mortgage or a car loan and you apply with multiple lenders within a short window, usually 14 to 45 days, The credit bureaus typically count all of those as a single inquiry. So, rate shopping doesn't have to hurt you. Now, here's something most people don't realize. Your score can take years to build, but can be damaged in a matter of weeks. One collection account, one default, one serious delinquency, these can stay on your credit report for up to 7 years. A bankruptcy can stay for 10. That asymmetry is brutal, and it's exactly why understanding this system matters before you make a mistake, not after. So, how do you actually build a good credit score? The foundation is straightforward. Get a credit card, ideally a starter card or a secured card if you're starting from zero. Use it for small, regular purchases like groceries or a streaming subscription, and pay the full balance every single month without exception. Set up autopay so you never accidentally miss a payment. Keep your utilization low. Don't apply for multiple new accounts at once. And then be patient because time is genuinely one of the most powerful factors in this entire system. There's no shortcut to a long credit history. You just have to start and then not mess it up. If you're starting completely from scratch with no credit history at all, a secured credit card is your best first move. You put down a deposit, usually between $200 and $500, and that deposit becomes your credit limit. Use it like a normal card, pay it off every month, and after 6 to 12 months of consistent behavior, most issuers will upgrade you to a regular unsecured card and return your deposit. It's a slow start, but it works. You can check your credit score for free through several platforms. Credit Karma, Experian's own app, and many banks now show your score directly in their app at no charge. You're also entitled to one free credit report per year from each of the 3 bureaus through annualcreditreport.com, which is the only federally authorized source for that. And now, here's the thing I promised you at the beginning, the part that almost nobody stops to think about. 2 people can earn the exact same income for their entire working lives. Same job, same salary, same city. But the one with an 800 credit score will pay hundreds of thousands of dollars less over their lifetime in interest on their mortgage, on their car loans, on everything that involves borrowing money. We're talking about the difference between paying 3% interest on a home loan versus 7% on a $400,000 mortgage over 30 years. That difference is over $300,000 in extra interest paid. Same house, same neighborhood, just a different 3-digit number. Your credit score doesn't just affect whether you get approved for things, it affects how much everything costs you for decades. That's the number you're actually managing every time you swipe a card, pay a bill, or open a new account. If this video helped you in any way, hit subscribe. There's a lot more coming. Thanks for watching. I'll see you in the next video.